All right, everybody, we are live. So everybody, welcome to the Sunday live stream. I'm joined as ever on Sunday by Jerry V. Hall from Costa Rica. Jerry, how you doing today?
Hey, I'm doing great. Hi, everyone. Hope you're having a wonderful Sunday. And for those of you in fantasy football like Rob, who are entering your playoffs, good luck to you all.
Yeah, I mean, thankfully I had an ace in the hole, the manager who was doing everything for me. It worked out pretty well. So anyhow, today let's talk about assets and portfolio diversification and where things are going. Now, we already know that the market itself is tanking. I think there's going to be more tanking coming up. I don't think December is going to be a hellaciously great month, but we'll see. But I will tell you that in the background, I've taken a look at this, and the dollar, Dixie, US dollar index has been dropping. Now it's up like it says here, like plus 0.06, but over time, as we've taken a look at this, I mean, we've gone from just the beginning of this year, it was 109.64. And now we've come down. I think the lowest point was around 96. We rallied up a little bit, 100, and now we're back down again. And the thing that concerns me about this, Jerry, is that there's something weird going on with the dollar, because usually when the strength of the dollar rises, Bitcoin goes down, because people are like, I don't want to hold the dollar. I want to hold some other type of assets, whether that be risk on, like Bitcoin, risk off, like gold or equities or whatever else it is. They want to get out of the dollar because it's not as strong as it used to be. And this is a nice little chart here, Bitcoin price versus the DXY. And we're going to see that, you know, again, it's like the opposite effect. In blue here is Bitcoin, and in red is the dollar, the DXY. And we're going to see that, you know, as the Bitcoin rises up, we can see the dollar going down. Now there's a little bit of fluctuations here. Nothing's perfect, but we can just see here again, it's like an accordion going in and out. But then something happened. Again, Bitcoin's going down here. Dollar goes up. Dollar goes down. Bitcoin goes up. Bitcoin goes down. Dollar starts to rise, and so on and so forth. But it seems like around 2024, actually, you can see it here. Around October, November, look at that. It just kind of switched gears. And now it's almost like it's kind of working in tandem with it. Now we can see here in January 2025, Bitcoin and dollar were doing pretty good. DXY at 109, very nice. And then we come down, and then again, Bitcoin rallies up, dollar rallies up, Dixie goes down, and then Bitcoin, of course, goes down. So when I take a look at this, it kind of concerns me, like this is a little bit of a fluctuation of how things usually are. And then it comes down to the Trump administration. Maybe it was because when Trump came into office, the whole thing was, remember this thing called a Bitcoin strategic reserve, Jerry?
I do.
I do too. Nice promises made. I don't know about the promises kept part, but here we are. And then this was from the Kobeshi letter. You should definitely check them out. President Trump has asked when he wants interest rates to be next year, 1% and maybe lower than that. And it says it very poignantly, correctly. You don't own enough assets. So Jerry, this is a lot to break down. And then, you know, I'll talk about like, you know, what my portfolio looks like. But help us break this down to what's going to happen here if rates start to lower. And then what does that mean for, because quantitative tightening just ended, which means we get the opposite at some point, and then the purchasing power and so on and so forth. But help me break that down to people to make that make sense about why they should actually get into assets when we see stuff like this and stuff like this.
Sure. Well, let me start with the DXY.
All right.
So the dollar strength index, to me, I make the most sense of its relationship to how I make decisions by understanding that its analytic nature, right, what the number says, has the most impact in what market. Well, the DXY has its largest impact in the foreign exchange markets. So when I want to trade dollars for Costa Rican colones, the stronger the dollar, the less colones I can acquire, right? Now, if I'm like you and I'm sitting in your place in Puerto Rico, you don't care much unless you're the guy importing Costa Rican papayas And your strong dollar is actually affording you to buy less Costa Rican papayas, right? And as that dollar strength diminishes, you are able to buy more Costa Rica colones, and the more colones you acquire, the more papaya you can acquire. So that's how I always make sense of what really the DXY is all about. It shows the dollar strength relative to the rest of the currencies in the world, right? And if you're importing and exporting, it's something you probably monitor greatly. Its relationship specifically to Bitcoin, I'm not exactly sure, because Bitcoin is denominated in US dollars.
Right.
So there's not a currency arbitrage per se, unless the source that you're buying the Bitcoin from is priced in that other currency.
Yeah. I don't want to go down that road. That's
or it's priced in colones or whatever. I don't see a lot of that in this market. So I'll transition now into the Fed rate.
Okay.
Typically, debt cycles are as such. I borrow X amount of dollars at X amount of rate, has X amount of carry cost. It's going to cost me this much to carry that loan.
Yeah.
When the ability for me to borrow more at less financial impact to me, that's a favorable refinancing situation. When it becomes favorable, I will refinance, and with the subsequent balance, right? I pay my old loan off, I have my new loan amount, it's higher, but my loan payments are lower, and I now have capital to deploy. I'll deploy that capital into assets, whether it might be physical equipment for my manufacturing plant, right? That's how it used to be back in the 70s and 80s. The refinancing debt cycle wheel was so that you could have more productivity in your business to increase your cash flows, to expand and scale your business. I think we're in a day now where debt has really become the tool to acquire more assets, because we understand monetary policy and we understand the train isn't going to stop. Therefore, every human, whether you're an individual like me or a small enterprising business like you, or a large Fortune 500 company, or even a company like Strategy, we understand the game is acquire the assets, right? And so I think we've seen a shift in business where companies are not just refinancing so that they can increase their R&D or increase their data center capacity or what have you. They're actually acquiring assets that generate other cash flow or other yield or other revenue in some way. You and I choose to buy Bitcoin, even though it doesn't produce a yield yet.
Makes sense.
But you understand that it's that lowering of the rate from the Fed is the basis in which banks decide their rate to lend.
Right.
The whole idea is to keep the debt cycle constantly churning over. Refinance. And that's why we see these cycles.
And they keep going again and again and again, is what you're saying. And it's like it never stops, right?
Absolutely. There's a few folks that I followed that helped me try to understand this relatively complex topic. Raoul Powell in Real Vision has a lot of really good content from and about this topic. But it's also easy that you can do AI searches now and look at different industries that debt is at the core of their business: auto loans, used auto, home, etc. Right? These are big industries with debt, and you can follow those. And then the other element is looking at bond issuance from both municipalities, corporations, and the United States government.
Yeah, exactly. So yeah, those are good people to take a listen to on certain topics. I'll say that. But just to hammer this home, it comes down to this. This is what Trump wants. And because he's going to get rid of Jerome Powell, I mean, he's not going to get rid. Jerome Powell's going to step down. We know that's going to happen in April. He's going to put in the Federal Reserve chair, and it's going to be pretty much a pro-Trump appointee. He has to go through regulations and processes that actually get confirmed. That's going to take some time. Once that happens, though, rates are going to start to fall, and you're going to keep going down. And that's the big thing. So like when you were talking about, you know, the funds rate, as you were saying, like this was, it seems like from 2009, when the federal funds rate was pretty much zero, to around this time, pretty much zero. And then they started to raise a little bit up. And then this is in 2018. They topped out in 2019. And of course, coronavirus hit. And this again was zero. And then we went up again. I think this was the right time to accumulate assets. And there's two things to note about this. This is what Jerry talks about. Essentially, the people got it. They're like, we want to get out of the dollar, we want to get into assets. And that's why we're talking about it today. And really, it's going to come down to the split between the haves and the have-nots. But before we get into this, I want to play Howard Lutnick. He is the Commerce Secretary. And just like 30 seconds, but just tell me if you agree with what he says here as far as how people are doing. Let's take a listen.
If you just study it comparatively, you would see the United States of America is paying too high. These people are too afraid. Jay Powell is too late, but maybe he should be called too afraid to lead the greatest $30 trillion economy in the world. We should be leading with our front foot. Instead, we're always leaning back as if something bad is happening. We are doing great. Nothing bad is happening. Greatness is happening. We're growing 4% GDP. Come on.
Yeah, so I mean, he's right on the GDP part, but does it feel great to everybody in the comment section? And I think the ones that say, yeah, it's freaking awesome. This is the most fantastic thing of all time. You probably got a lot of assets. That's how it works. If you have assets right now, you're like, it's feeling pretty damn good. I mean, we've got pretty much all-time highs for real estate. We're looking at equities across the board. Now, of course, the S&P 500, we're talking like the top ones, the Mag 7s and things like that. But then if we just take a look, this is from Nick over at Coin Bureau. Household net worth by percentile group. See this blue? Like the dark, what is this, navy blue? I'm almost colorblind. Anyhow, about this dark blue here, that's the top 1%. Look at the divide as time has gone on, just like what I said. 2008, 2009, 2015 or so was a pretty good time. Then a little bit of a bump. And then it just kind of rocketed up, especially after coronavirus, as the haves did what they were supposed to do, which is just buy a ton of assets. And now you see the difference between the top 1% and this like light blue. This isn't like the 50, but this is the 90 to 99th percentile in household net worth. Look at that gap. That's 70% roughly, maybe 65. And then the gray is the 50 to 99th. And this little small tiny sliver, whatever color this is, that's the 50% and below. So what do we take from this? We take from this very simply, which is this. It's awful that we have so many people in the bottom half. It's awful we have so many people 90% and below. It's a incompatible type of division of wealth. However, if we take our lessons from that and say, what did they do I didn't do? It's assets. And people say, well, how do I get more assets? Investing is boring. I just watched Ben's video. It was pretty great. He said, investing is boring. It should be boring. All the stuff that people clickbait you into watching and how great it is bullshit. Really what it comes down to is this is a boring situation. Just like Stanley Druckenmiller says, the best investors do absolutely nothing. They sit around, they read, and they twiddle their thumbs. Okay, I didn't say that last part. But that's essentially what is going on. And that's what I think everybody needs to get into their heads, is that with investing, it's boring. And people make it such exciting and they try to explain it, but that's just how it is. It's going to take time. Jerry, did I miss anything before we go on to the next thing?
I don't think you missed anything at all. I mean, there are obviously there's an element to Lutnick's communication there that I think is a little disingenuous when you look at default rates for used auto loans, when you look at default rates for personal credit cards. Visa, MasterCard, American Express, the default rates that these companies are experiencing indicate that America as a whole is not doing well. And I think your chart said it best. The top 90%, so 90% to the top, or in other words, the top 10%, they're doing fine.
Yeah,
right? I'm working my butt off every day to get into the top 10%.
yeah.
I want to be that light. I want to be anchored in that light blue, right? I might get lucky and one of my companies thrust me into the top 1%, but I doubt it. Most likely, the best I will achieve is the top 10%. But you know what? That's not horrible. That's going to be a really nice place to be.
I think that's a great place to be. I've never. I got to tell you, the people that I meet that have the most money are the most miserable people I've met. For some reason, I don't know what it is. I mean, they're relaxed, they don't have to pay the bills, but I mean, on the other side, it's not like the greatest thing of all time. However, I will say, and Selena here brings up a good point, it's clearly a crypto issue. And she's right. The Russell hit an all-time high, S&P 500 near an all-time high, gold is at an all-time high, commodities are at, not all of them are all-time high. Crypto should logically be pumping with it. And that's the thing, it's not, and we're actually going down. So there's a couple reasons you can take a look at it. Like if you're like me and believe in the 4-year cycles, you're like, well, that's it. I mean, we pretty much hit our top in Q4 2025. And of course, people say that doesn't matter because we have the business cycles coming up, like what you talked about before, as far as PMI, it's still below 50. So of course, it's going to get extended out. Quantitative tightening just ended, which means that we have so many months before we get quantitative easing. And then when the Fed chair comes in, they start to lower rates, and that is the big catalyst. I say maybe, but I will tell you, again, 2026 is midterm year. When we have that, there is usually a little bit of discourse in the markets, not just our markets, all markets, because of the ambiguity. So I don't know where it's going to go. However, there was this. I mean, you're going to get a bunch of reasons for why we're not going up. But I did see this, and I want to talk about this, Jerry. This is from Wimar.x. Wintermute, which is a market maker. Ever since October 10th, they've been dumping and dumping and dumping. And they're a market maker. If you don't remember what happened on October 10th, that was when there was some discourse between Binance and a lot of the different exchanges that were hooking into Binance for price action. And a lot of people got liquidated. A lot of market makers got wrecked, and a lot of people got wrecked. But it seemed like Wintermute, which was one of the bigger market makers, they keep dumping. And it seemed like every day around 10 o'clock a.m., every couple of days, we just get more dumpage. And you can see it. You can feel it. It's like once Bitcoin goes to like 92, 93, it gets kicked right back down to 90K or 89K, like it is today. And then it goes to 92, 93, and it gets kicked right back down. It looks very structured, very manipulated, but I mean, that's what it is. But Jerry, what do you think about this?
I think that we always should try to keep a mind to what are the incentives, who's incentivized to do what, right? So the question is, or was for many years of my exposure in this space was, are the institutions truly going to embrace this asset class, right? Is blockchain, is Bitcoin going to be embraced? Are we going to get regulatory clarity? Are we going to get institution buy-in? Those were the big questions, because we knew those were the largest pools of capital in the world. And if they did decide to come along, all of us early people would be rewarded greatly. Well, guess what? It's happened. And now we're going, what the heck is going on? This is supposed to be great for us. You know what? The chapter hasn't been written yet. We're still in the race. And the truth of the matter is, when you look at the incentives, case in point, the MicroStrategy JP Morgan element, JP Morgan incentivized to get into this space, but not at $120,000 of Bitcoin. So what could they do? What could they do? What was in their legal control? Well, we learned about the way they change the margin strategy, the margin capacity for people who were going to take MSTR on margin. Oh, holy tamale, that changes by 50%. That changes a tremendous amount of how you would interact with that in the market. The short positions, all of these indicators, but none of the underlying fundamentals have changed. We know they're coming. We know they're building products. So to me, this is all just a bunch of noise. Let's let the big boys play and manipulate while we get a chance to accumulate.
And this is the thing, like, it's because we can't control what's happening over there. I was going to take a look as the outsider looking in and going, maybe they do this or maybe they do that. And this comes down to the question for Sandy. My question is, if we're in a bear market for the next couple of years, what assets or ETFs should we be buying right now? And that's the crux of essentially the title and the thumbnail of this video. First of all, say we're going to be in a bear market, like it's going to play out like exactly like 4-year cycles. If that is true, then we are going to bottom out in October 2026, which would be a little bit less than what we've done before. And it is kind of interesting, isn't it, that we topped out in 2017 in December on the 4-year cycle. In 2021, we topped out in November. And if all things hold true for this year, then we topped out in October. December, November, October. It'd be interesting if it actually works out like that, but it's anybody's guess. So like the next question is, well, what do we do? First of all, I'm not 100% convinced that this is going to just lead us into this massive drop-off of 70 to 90% like it was in the past, if that holds true. And like I've said in all like the last couple of weeks, I am short-term bearish, but I continue to buy assets like Bitcoin every single day. So the thesis is still the same. As long as I know that the US will continue to debase the fiat currency, which is the US dollar, by printing more, and quantitative easing is coming, and the purchasing power is going to go down. If that keeps continuing, then I know that I can't stay into a lot of cash. However, this is an old slide I put together like 2 years ago, 2023, and it's almost the same right now. I mean, I've got, as far as like cash, around 20%, somewhere around there. There's some D.A.N plays I have. Crypto itself is around 30. It's been fluctuating because the altcoins have been sucking, but my portfolio is roughly 80% 20 Bitcoin to the other stuff. And then also real estate, which has actually been appreciating. And it doesn't really matter to me about the appreciation value of the real estate, is the cash flow that it gives me, which I can go into and do other things with, say like equities, say like precious metals, and say like crypto and stuff like that. So it just depends. So like, what would you do right now? I obviously can't answer that. I know just for me, I'm personally just sitting back. I'm buying Bitcoin every single day. If there's some massive opportunity for real estate and it comes my way, well, I'm sitting a little bit of cash and I can use it that way. But right now, I'm not actively looking like I gotta buy everything right now. And like I said before, I know it's not the story you want, but it's the story that I'm doing right now, which is it's kind of boring. Just waiting for my time and going from there. And one of the things I will say is that I've been using the risk indicators or the risk levels. And somebody asked me the last show, they said, hey, can you do that, these risk levels for Bitcoin? And you're doing your dynamic DCA. Can you do that for other cryptos? Yeah. Well, here's Ethereum risk level. It's at 0.5. To top out is at 1.0 at $12,000. I don't think Tom Lee's, actually, I think Tom Lee's even higher than that. They got one for BNB, Ripple, Solana. What is Solana? Wow, 0.4, 130. Jerry, any altcoins you want to take a look at? As I'm
no, not necessarily. I mean, no, I'm not putting really a lot of time and energy into altcoin accumulation.
Yeah.
I've got what I've got. You know what I mean? Every once in a while, something will pique my interest, and I might take a small couple $100 position if I can earn some kind of yield on it or compound it in some kind of way.
Yeah, that's a smart way to do it. I'll just say this, like for me, for the dynamic, when I'm at the 0.5, I don't really accumulate until if it's above 0.6, but once it hits 0.5, I start. And then once it goes below 0.5 into 0.49, I double up. And then once it gets down to 0.39, I will triple up. and that'll be the price point. Look at Jerry. Weren't we talking about this 85,000 not too long ago? You were going to back up the truck.
I said I was going to back up the truck when it hit 80.
Okay.
And I've got a pool of cash. Now, I did buy some at 85, which was a low a couple of weeks ago.
Yeah.
But I'll tell you what I'm the most excited about, and this would be a direct answer to Sandy's question, would be ETFs where I get a tremendous amount of exposure to NVIDIA, AMD, Tesla. I would love to find somebody who's tokenizing those assets and has some kind of credible track record. I would hate to put money into a token that went away tomorrow, but the barrier to entry to acquire Tesla on a daily basis, or those type of NVIDIA on a daily basis, it's the cost. It's just prohibitive. I can't do it. But if it was tokenized, and I could start getting little satoshis and acquiring, oh my goodness, I can't hardly wait for those, because those are companies I don't think we even comprehend how large they're going to be or how valuable they're going to become.
Yeah, and that's just it. It's kind of hard to see it right now because everybody is in fear or extreme fear, and they don't really want to do too much. That's just pretty much how it is. So to sum it up, what we just talked about, boring times. I expect things to go down more. I expect the market to really start sucking, especially with, I don't know if you followed this, Jer, from the Bank of Japan. Looks like they're going to, it's going to be, rate hikes. It's coming up next week.
Yeah, you talked about this. In my experience with the carry trade, the Japanese carry trade, people borrowing in Japan to convert their yen into dollars and buy things with those dollars because the interest on the yen is next to nothing, right? So if you have to pay 3% in the United States for dollars, and you can pay 0.01% to borrow yen, then the only risk that you're taking is in the yen to dollar conversion on the day that you do it. And if you do it immediately, it's not a big deal, right? It's almost boom, boom, boom. So now all of a sudden you're borrowing it next to nothing. And when you can borrow it next to nothing and acquire things that are going up and actually get an advantage over the US debt market or what have you, you're arbitraging in your favor, right? If you and I had large pools of capital, that would have been a thing you and I would have probably been doing for the last 10 years. Because it's been an incredible trade, the yen carry trade. However, when they change that, now all of a sudden, if you have to refinance your yen loan at a higher rate, it's going to cost you more to repay it back. Now what do you got to do? A lot of times it's these hedge funds, and what they have to do is liquidate some of their assets. So when that yen carry trade changes, now all of a sudden the hedge funds that were borrowing for next to nothing, converting to dollars, buying Bitcoin, they will have to sell Bitcoin. You will see a direct correlation. But you won't see those right away. It takes a while because remember, when you're financing and refinancing, you're pushing out terms.
True. So it's going to take a bit.
You don't necessarily see it at the time that it happens.
Got it. Well, it's going to happen. That's why I can say, like, I don't see December as being too fantastic. However, if I'm wrong, I have insurance. I just keep using the risk levels and go from there. But this will lead us to our last point, and then I swear we'll get to the Q&A. Sorry about this taking a little bit longer today. But it really also, another thing that it comes down to is saving funds where you can save it. I want to play something for you. And if you're not from America, this is going to sound incredibly insane, but this is our healthcare system at its finest. And I think that as we move forward, that decentralized healthcare will be the fix. Listen to this. If you're in America, you're going to nod your head. If you're out of America, you're like, that's how much you guys are getting screwed over? Yes, this is it. Take a listen to this, about 2 minutes.
Okay, how are people surviving? How are they doing it? I am the benefits administrator at my small business. I have less than 20 employees. I have 11 enrolled in United Healthcare. So we just got our renewal information. So we have 11 employees that are they just insure themselves. We have one that does them and their spouse. We have 2 that does employee and child, and we have 1, that's me, that enrolls their family. So my family, it consists of my husband, myself, and our 2 young daughters. Okay, currently we pay $1,268 a month in premiums.
A month.
So what premiums do is it just gets you access to the plan. Okay, it's not any of your health insurance costs. We experienced for this year's renewal, so in 1 year we had a 46.53% increase. Now for my family of 4 to have access to their health plan is $1,900 a month. That's $23,000 a year. We're all completely healthy. I don't really do the whole go to the doctor thing. We use it as we truly need it. I've got some real trust issues. But riddle me where the average family is getting $23,000 to pay for their premium. That's not to mention that once they actually have a health event, they have to reach their $5,000 deductible before the plan pays anything. It's so disturbing. So let's say that I had a health event where I broke my arm. I'd be paying the $23,000 in premium, and then I'd have to pay another $5,000, so we're at $28,000 before I receive any assistance from this plan that I paid $23,000 to be a part of. Oh, sure, it does pay for my wellness visits where they'll inject my kids with A, B, and C. So that's great. No thanks. Ridiculous. This, United Healthcare, you should be ashamed. This is embarrassing, and this is not accessible for American families.
I just want to bring that to everybody's attention because I used to have United Healthcare, and I can validate that. It's extremely high, and that's America for you. And we did this video about decentralized healthcare. And I add this into the crypto critical videos. It's not cryptocurrency or digital asset per se, but if you're in America, there's options for you. I'd like you to take a look at this. I sign up for it myself. Again, links in the description in every video that I do. And Jerry, tell us just again how you do it in Costa Rica.
I pay $40 a month for insurance for healthcare here in Costa Rica.
Wow. That's crazy.
Again, it's back to the incentive stuff, right? Costa Rica mandated laws that medicine and healthcare are not to be, they're not for profit. They're not extractionary businesses like the mechanic, right? The mechanic is incentivized to fix as many cars as possible, and he makes the most money when he fixes more cars. They taken the incentives out of the medicine game, so doctors do not earn more money when they see more patients.
Yep, exactly.
It's all about incentives.
Yeah, it is. And I worked in healthcare for 2 decades, and I can tell you it's pretty much the bottom line. It's a factory. Get them in, get them out. And again, that's why like when that lady said 28,000 per year, essentially. I mean, and that's just for her if you broke her arm. Yeah, it's about right. And don't even get me started. Like if you're having like bypass surgery, if you have a cardiac stent needed, if you have to go through hemodialysis, if you have to, you have any type of stage 2 and beyond cancers, forget about it. So like when we talk about buying assets, it's great we talk about this theoretical stuff, but if you don't fix the underlying issue with where all your money is going, I think healthcare is one of those. It doesn't matter. Of course, that's only for the Americans. Everybody who's not American in the comment section is like, that's ridiculous.
There's elements of that, Rob, that I believe are everywhere, right? And so when you looked at that graph you put up with the basically income and inequality differentials, the reason the gap is getting so large between the haves and the have-nots are because of those type of elements, whether they be in the food supply, whether they be in the medical industry, whether they, there's a whole bunch of these essential elements that are under siege like that.
Exactly. Under siege. Hey, you know what? This is a good point right here from Aristotle. It says AI gets diagnosis right around 93% of the time, doctors 80%. And I saw that this same study, and of course, as it gets better, it's going to be even more accurate. But people will ask, like, well, you know, where's all the funds that were supposed to flow into crypto digital assets? Well, maybe it's manipulation, maybe it's timing, whatever else it is. But I can tell you, like, when people want something that works, it's better, cheaper, faster. There's nothing better, cheaper, faster right now than going on ChatGPT, going, I got a cough, I'm kind of lightheaded, I've got blah, blah, blah. What is this? And they can spit it out and it's free. Instead of like having to go, now, of course, you always want to go to the doctor. This isn't medical advice for Pete's sakes. I'm just saying, like, if there's a reason why people are like, where's everything going to AI? Well, for the past 2 years since ChatGPT got spit out, stuff works. And it's only going to get better. But maybe there's a collapse like Robert Kiyosaki says. But that's it for today, everybody. So if you like today's video, there's a lot of stuff we talked about. Sorry, we went all over the place. But give us a like and subscribe. And then now we'll do a little Q&A. We'll go from there. And that's it. Hey, I would like to say, though, a shout out to Crowd Health. That's the decentralized healthcare I'm using. They allow me to, like, you know, you just go and get your labs drawn. And then if the labs are like in a certain range, you actually get like a deduction, which I thought was pretty cool. So I did that, and I had like my body mass index by a DEXA scan, and worked out pretty well. Anyhow, check out that video. All right, Jerry, anything to add about crazy healthcare?
Well, you know, I'll tell the world. I have reached out to Rob because I'm building a product that will be available through Compute Portal called Health Portal. And it would be basically, you have a machine with your own AI in your home attached to a whole array of medical diagnostic equipment, whether it be your wearable watch, your ring, your one lead Bluetooth EKG, or a blood test device that takes a 5-part blood differential CBC test, runs it through an AI, and tells you what's going on with you. So you can, in an AI, type in your symptoms, but wouldn't it be better to actually have real, live, actual biological data? Let's scan your blood. Let's take a blood test. Let's have your wearable talk about respiration, blood oxygen, and heartbeat and blood pressure, right? Let's use real life analytics measured against real medical data to tell you what's happening.
Yeah, sounds interesting.
How many people go to the doctor and it's not necessary? There's no major life-threatening outcome. It was because they didn't know what was going on.
Sure. You know, I got to tell you, there's no money in maintenance and staying healthy. There's money in sickness, though. That's for sure. Anyhow,
Right.
Yeah. Jerry, you got to send me one of those kits. I'm gonna try those.
Well, when I get to, I told you I want you to come in on it with me. This is something I thought would be a great business for us to dive into.
We can do it. We can do anything.
We can do anything. That's the attitude right there. That's a good attitude.
Yeah. I mean, after I saw my altcoin portfolio go down, I was like, I can do anything. I can definitely go down. I can definitely go up. Ooh. Question, I'm trying to wrap my head around risk levels. Can you give me an example of investing $1,000 with risk levels for Bitcoin? Well, if I had $1,000, if we're taking a look at, say, like these risk levels here. So it's not like, well, there's a couple ways to look at this. There's dollar cost averaging, dynamic dollar cost averaging, and there's value cost averaging. And then there's lump sum, if you want to do it that way. If you said, I got $1,000, I'm going to lump sum it, bam, I'm going to put it into Bitcoin today at 88,700, whatever the heck it is, 88,750. Wow, it's dropping as we're talking. Then you can do that, but it feels kind of crappy when it goes down to 80,000, then 75,000, then 70,000. You're like, damn it, maybe I should have dollar cost average. But you can do another thing called value cost average. So you take $1,000, split it into fourths, 250, 250, 250, 250. And then you just, every week you put it in. Or you can do what's called dynamic DCAing, and we do like with this. Let's say you take that $1,000 and you say, okay, I'm going to invest $50 a day. And for every day I put $50 in, I'm only going to do that at like between let's just say 0.4 to 0.499, $50. If it goes above that to 0.5, I'm going to spend less because it's getting more expensive. I don't like to buy expensive stuff. But if it goes down to like 0.399 and below, maybe you double up. Instead of $50 a day, now you're spending $100 a day. And if it goes down to 0.299, which would be in the 63,000 somewhere level, then you're like, okay, now I'm going to triple up. I'm going to spend $150. That's called dynamic DCA. Or you can just be like me and for some other stuff and just go, here you go, $10 a day, whatever happens, happens. So it's up to you how you want to deal with that. Jerry, anything about that one?
Yeah, I think it's super important when you're analyzing risk to have a consistent benchmark to put it against and a time frame in which to measure it. So, for instance, question, I'm trying to wrap my head around the risk levels. Okay, the risk levels, let's say the benchmark we're going to use is the S&P 500 index. So, if that's the index, now the only thing we need to do is type in the chronological periods. So, the risk of Bitcoin going up or down relative to the S&P index over 6 months is there's easily a 50% chance that Bitcoin will lose money relative to the S&P 500 in 6 months. But in 1 year, that risk compresses. 2 years, now all of a sudden the track record of Bitcoin comes in, the track record of S&P comes in, monetary policy metrics come into play, and now all of a sudden you start getting out to 4 years, you are at almost 100% you're going to make more money than that if you stay in it. So everything's relative to what you're benchmarking the risk against and the length of time that you're asking for the risk to be measured.
Yeah, it's all about time and how long you can stay somewhat rational in an irrational market. Here we go. Let's see.
Do you need that $1,000 to make money in the next 6 months? You're probably better off out of Bitcoin.
Well, it depends on where you think. Where's the melting ice cube, right? So, I mean, if we're going to get more inflation and you can't beat out 5 to 7%, then you probably want to invest it. Or if you need that for bills, hey, I gotta pay my mortgage. Just depends. Jeff said, if I had $1,000, I would be patient and wait until August 2026, then buy Bitcoin. You can do that. And this is the thing that I always think about is like, if I just would have followed the 4-year cycles last time, I would have been way, way, way farther ahead. I would have waited till November 2022, dumped everything in around November, whenever it was at 20,000, 19,000, down to 17,000. But then I'm like, what if there is some slight changes here and we do get a little bit of a curveball? Well, it's not so bad. I mean, I'm not buying at all-time highs, and it'll take some time, but here we are. So I'm just kind of hedging my bet to where it is. And I could be wrong.
More people lose money trying to time the market than people that make money by having time in the market.
Yeah. And then Devin says, a weak dollar is good for U.S. exports since our goods cost less for other countries. Or Trick Shot says Raoul Powell 5-year cycle might be right. It's a funny thing. Raoul Powell says
cycle is what he says. 5.5.
What is it? 5.5. So what does that mean? That we're going to be in 2027?
Instead of a 4-year cycle, he's basing it off of debt refinancing.
Yeah, I saw it.
And 5.5 is that mean.
Yeah. We'll see what happens. I saw that one, and I also saw Robert Kiyosaki was sitting down some podcast saying, yeah, AI is going to crash everything in 4 to 6 months. I'm like, now that's interesting, because in 4 to 6 months, that's when I think Raoul Powell is talking about this huge run-up. And if he is talking about the same run-up, well, someone's wrong. And that's the great thing. But no one will remember I don't want to remember who's wrong. They're just like, hey, the price went up or the price crashed.
The internet never forgets, my friend. Trust me, the internet never forgets, as you've been made aware of from some members of your audience.
Yeah, that's the truth. Lone Wolf says, so going back to the healthcare issue, I have epilepsy and full-time crypto. Full-time crypto does not come with the healthcare. That's true. Paying out of pocket is not cheap. It certainly is not.
No.
So watch that video, Lone Wolf. That might be something. But yeah, Abel says, oncologists make more money than brain surgeons. Cancer is a racket. For pharmaceutical companies, it sure is. That's for sure. What else? I think that's banana. Bananas on my A. And then Farrar says, Bitcoin is falling. Happy Christmas. Maybe we get a Santa rally toward the end. If we keep going down to like 50,000, then we bounce to 60,000. Everybody can say, see, the Santa Claus rally is real. Anyhow, we'll see what happens. That's it for today. So look, like today's video, thumbs up, subscribe, all that great stuff. We'll be back in 1 week. Actually, when is Christmas? I think we got some time. Oh, well, last thing. Christmas and until January 5th, we're going to be doing the 12 days of Christmas. So I'll be giving away specific things. Some friends of the show, like the guys from TANGEM, stuff from iTRUST, and some curveballs that I'll be sharing with everybody next week. Anyhow, that's it for today, everybody. Thanks so much. See you on the next one.
Pura vida!